you two both. No, Adil, David, move your chairs that way. All right, come. Hello, everyone. Let me know if my audio is working. Hello. I'm not sure if my audio is working. Let me know if you guys can hear me. Marianne, maybe you want to go to another room and see if the audio is working. Yeah. Audio is working. I was told audio is working. Marianne, we're good. Audio is working. Let's see. Let's see. Okay, cool. All right, guys, let's go. I was gonna do a live video. Come on. Yes. There was little bring your kids to work day today. Let me see if this thing is working for you. Okay. Are we good? Video is working. All right, everyone. Boris Musheyev here. This is live Q&A. Ask us any tax questions today. Let me fix up my camera. All right, cool. Let me know if you guys can hear me well. So we go live every Thursday at 12 p.m. Eastern time. And so you guys can ask any tax questions, and I'm here to answer any tax questions that you have. So we're going to get started. Do we have any questions coming in? If not, we're going to cover a little bit of a little preview of what I'm going to be talking about next week when I will be releasing a new video, and that is owner contributions. So a lot of business owners don't really know the difference about what it means to, like, what does owner contribution really mean? When I put the money into my business, do I pay taxes on it? Or is it my money that I put in? Can I take the money out? Do I loan it? And so forth. So just very simple in general terms, when you start your own business or you already have a successful business, whether you're making millions of dollars or hundreds of thousands of dollars in your business, the money that you put in into your business, it goes in as owner contributions, right? You're the owner and you're making contributions to the business, whether it's because you're short on capital or whatever that may be, or there's not enough cash to cover the next payroll. What you can do is put your own money back in. Now, the business can choose to pay you back that money, return that capital to you. Now, if you're recording it as owner contributions, the business doesn't necessarily have to pay it back to you, or you can loan the money to the corporation, and the corporation does have to pay you back. It depends what your intentions are. Sometimes you give the money to the business, and you're like, you know what? I'm just funding the business. I don't need the business to pay me back because over time I will take it out as distributions. There's no need for you to go to the hassle of recording a loan. Okay. Now, if you want the money back from the business, then you do need to give the money as a loan, and that loan will be repaid back to you. Okay, awesome. Now, that's a little bit of a preview of what we're going to be doing. I just wanted to kind of start this off. We already have a few questions coming in. By the way, we're testing a new microphone. Let me know if this microphone works well, better than the other one, and if you can hear me and the voice is not kind of distant and so forth. Now, let me know in the chat. I definitely want to know. Now, also, for those of you that participate the most with questions, okay, you get our S Corporation Tax Secrets book for free. Now, you also get this baby right here, Thinking Outside the Tax Box. It goes on Amazon for like 21 bucks, but it's yours today for free. And the third winner is going to get a free review of their business and personal taxes. That's right, 3-year look back. The only thing you have to do is, number one, participate, and number two, stay till the end to see if you are the winner. Last time our video got cut off short right before when I was pronouncing winners. I didn't do it on purpose, I promise. I think we still were able to get those winners and send them whatever it is. Were we missing somebody?
Well, I've had only one person who I was able to tell to reach out.
So whatever, the video will cut short, and today we'll try for the video not to cut short. All right, awesome, great. Perfect. Thank you, guys. You can hear me well. So let's start with the first question.
Okay. The first question comes from...
Can you guys hear Mariana, by the way? Let me know in the chat as well.
Yeah, let me know if you can hear me as well. First question comes from Alex Vinoy. Is there a tax benefit if I rent some of my extra business rooms as office space for other businesses?
Is there a tax benefit? So who was it? This is Alex, right?
Alex.
Alex, hello, Alex. Say hello in the chat. Okay, awesome. You guys can hear her. So Alex is saying, Boris, if I've got a big enough home that I have a home office in it, if I'm understanding correctly, right? And now I have extra rooms in the home and I want to rent it out to other businesses as well, okay? Is there any tax benefit? Now, let's kind of dissect that a little bit, Alex, right? So first of all, it is going to be an income to you. Now, any money that is paid to you will be taxable to you for the use of that other space. Now, if that other space is being rented for less than 14 days under the Augusta rule, then you don't have to pay any income tax on it. But if you're already renting your home to yourself under Augusta rule, you do have to pay taxes on it if everything is going to be more than 14 days. Now, but let's say you do have to pick it up as an income. That money that is being granted to other people, that's okay, because now you can take deductions against it. Anything related to that home office, the percentage, the portion, not the home office, excuse me, to the rented room, the percentage and the portion of your utilities, your mortgage interest, your property taxes, even depreciation can be deducted. So is there a tax benefit? Well, the thing is, you can take deductions against it. Will you still walk away with an income for which you will end up paying tax? Most likely. Next question.
Okay, question from Steven Anderson.
Steven, what's going on? Say hello in the chat, like the video and love it so YouTube can promote it to more people. Let's go.
Good morning, Boris. Question.
Good morning. Good morning. I don't know about that. It's more like an afternoon.
Internet rates are high, causing higher mortgage payments. Does writing off the mortgage...
The what is high? Say it again.
Internet rates.
Okay.
Are high, causing higher mortgage payments. Does writing off the mortgage interest at the end of the year balance out the higher payments?
For internet? Maybe he meant interest.
Oh, that makes sense.
Did he say interest?
No, he wrote internet.
Okay. I need you to read from the screen if you don't mind, because otherwise I can't hear you well.
I'm
okay.
sorry.
So let's read the question again so we can all hear it.
Interest rates are high, causing higher mortgage payments. Well, obviously. Okay.
Yeah. Guys, she's not an accountant by trade, but
no, not at all.
We forgive you. Let's go. Let's go.
Does writing off the mortgage interest at the end of the year balance out the higher payment?
Balance out the higher payment. I'm not really sure what you mean by that. Do you mean like, do I get a higher write-off? Let's skip that one until you give us more clarification. Next, Mariana.
Okay. Question from Eddie Arshade. I have an LLC.
Eddie, what's going on? Say hello in the chat.
I have an LLC taxed as an S Corp. However, some of my income, 1099, comes in as my personal social security, as real estate office commission won't be paid to LLC, just agent's name. How should I handle this? I was told a Schedule C as both income and expense, with the expense line saying income reported under EIN number. Is this
so
correct?
Eddie's asking a question. Eddie's like, hey, Boris, I've got a business, which is an S corporation, but the money that I'm receiving from some of the vendors, they're making the payments out to my personal name under my social security, and they're giving the 1099 to my personal name. How do I handle it? I was advised, says Eddie, that I still report the income that is being reported to me on the 1099 to my personal name under Schedule C, and then I take other deductions saying income reported on S corporation instead. Eddie, that is exactly how it needs to be done. What happens is that sometimes, especially if you're an insurance agent or a real estate agent, and you've got your own S corporation, and some brokerage firms have you and not the S corporation, you close the deal and they wrote out a check and they send you a 1099 under your personal name with your social security number. Well, if you don't report that 1099, what's going to happen is that IRS is going to send you what's called a CP 2000 notice. Hey, you underreported your income. IRS doesn't know about your expenses, so it's best that you do report it on your personal taxes and take the expense for the same amount, saying, hey, I'm reporting it under a different EIN on my S corporation return. Next one.
Okay, question from Iron.
Iron, what's going on? Hello, hello. Say hello in the chat. By the way, we've got more people coming in. I see here now. We've got a couple of rules if you want to be here. Okay, a couple of warming rules or housekeeping rules. What is it? Housekeeping, not housewarming. Right? Housewarming, you make a party. Housewarming. A couple of housekeeping rules. You've got to participate in this live by asking any tax questions so I can give you an answer. Okay. For those of you that do participate, you get this book. You will win this book. All right. We're going to pick a winner. We're thinking outside the tax box. We're going to mail this to you. It's Amazon, $21. It's free for you today. S Corporation Tax Secrets book. It's $9. It's free for you. And the last winner, if you stay till the end, is going to get a free 3-year look back. We will personally review 3 years worth of business and personal taxes, but you've got to be a business owner. Let's go. Next question.
Okay, question from Iron.
Iron, hello. Say hello in the chat, Iron.
S-Corp shareholder distribution. Is it tax-free, but will I claim at the end of the year on my 1040 taxes? How does this work?
Say it again. S-Corp distributions?
S-Corp shareholder distribution.
Read it again.
Is it tax-free? How, if it is, how will I claim at the end of the year on my 1040 taxes? How does this work?
Okay, Iron, I'm definitely going to answer your question here in detail so you understand it. But a deep dive of this, I actually have a couple of videos on YouTube. Definitely check it out. But let's kind of take a look, a walk through this, right? S Corporation, it's a pass-through entity. The name speaks for itself. That means any net profit from the business gets passed through to you personally. Now, if you made $100,000 net profit in an S Corporation and you took, let's say, $70,000 distribution, that means you made $100,000 in the business, okay? You have $100,000 after all expenses and your salary sitting in the bank account, but you took out $70,000 as distributions and transferred it to your personal account. What do you pay taxes on? That's what Iron is asking. Well, really, you pay taxes on $100,000 net profit. I know it may be a shocker to some of you, okay? But you pay taxes on the net profit, regardless of how much money you took distributions, because S Corporation is a pass-through entity. Now, distributions, Iron, are not reported anywhere on your personal taxes. What gets reported on your personal taxes is a net profit from your S Corporation, and that is $100,000 net profit. It is reported to you on a K-1. So your S Corporation is going to issue a K-1 to you, the business owner, and then you're going to take that profit that is reported on the K-1 and report it on your personal taxes. Next question.
Can you give an example when it would make sense from a tax strategy standpoint to loan money to an S-Corp versus owner contribution?
Can I give an example when it would make sense to loan money to S Corporation instead of putting it as a contribution? That is actually a great question. It is not a question that I will generally answer this question, but in most cases, it really depends on your financial situation of the business, right? Because what happens is that there's a strategy involved in either giving the money as a loan to an S Corporation or owner contribution. Both can have some kind of a tax consequences when you decide to take the money out. Now, it really, really depends. So generally, I will tell you that you can do either or. That is why it's super, super important that you work with your tax advisor on this. Don't work with a tax preparer. Don't wait until the year end or after the year is over to be able to do this. Putting money into your own business really requires a strategy. Is it an owner contribution or is it a shareholder loan that needs to be repaid? Not a simple question to answer just over YouTube Live. Definitely make sure if you are in that case, you strategize accordingly. Next question.
Question from John D. Can you speak and explain about Section 179?
Can I speak and explain about Section 179? Yes. First of all, I have a great video on YouTube. Okay, it says bonus depreciation versus Section 179. But let's kind of talk about that. Section 179. So before the President Trump became president and a Tax Cuts and Jobs Act was enacted in 2017 and then effective in 2018, we had a bonus depreciation, which I believe was like at 50%, right? So that means that if you buy an equipment and you want to bonus depreciate it, you can take 50% of it. Then there's something that's also called a Section 179, which means, all right, you want to take 100% of a depreciation deduction instead of a 50% bonus depreciation before 2018. So you were able to do that with a Section 179. You're like, you know what? I'm going to take Section 179 and take 100% of a deduction. Now, Section 179 has a certain limits. The assets cannot be over, I can't recall what the limits are at this point because they changed a couple of times. But if you're a small business owner, you're definitely within those limits. Now, the biggest difference between bonus depreciation and Section 179 is as follows. Today, as we stand today in 2023, bonus depreciation is at 80%. So that means if you buy an equipment and you want to depreciate, take the full deduction on it, you can take 80% of it. Or you can use Section 179 to take 100% of it, given that you will qualify. In most cases, small business owners that tend to watch my YouTube do qualify. Okay, now you've got to still do planning around it. I'll tell you why. When you take a Section 179, let's say you take the whole thing out of Section 179 and it produces a loss to you, Section 179 section that gave you a loss on that equipment will not be deductible to you in its first year. It's going to be carried forward to the year when you're back in your profits. Whereas with bonus depreciation, even if you took only 80% of it, then it will let you take the loss on the business without carrying it forward. Okay, so that's one of the biggest differences. So that's why if your business is kind of breaking even and now you want to start buying a bunch of equipment to generate losses, make sure your accountant or your tax advisor speaks to you about, hey, if we do Section 179, you'll be cut off your losses and they'll be carried forward. Or if you do bonus depreciation, you'll get your losses, but the remainder of the 20% will be kind of depreciated over the course of the 5 years, 7 years, or whatever that may be. But I do want you to understand something, that if you are heavy in equipment buying for your business, ladies and gentlemen, please make sure you do some tax planning around it. Next question.
Question from Chris.
Chris, what's going on, Chris? Say hello in the chat.
I have an LLC with S Corp. I pay my own health insurance premium through my own personal credit card. We can set
I do
this,
too. Okay.
We can set this in Gusto as a deduction.
All right, great question. Okay, this is Chris, right? So Chris is asking a phenomenal question. Okay, by the way, for those of you that don't know, that there is a huge, amazing strategy for an S corporation owner. If you own more than 2% of your S corporation, on how to deduct your health insurance, IRS actually lets you to kind of double dip into that deduction. I made a video on it on my YouTube channel, but we're going to talk about it here as well. So Chris is asking, Boris, I pay for my health insurance from a credit card. Okay, I paid from my credit card, and I also have a payroll with Gusto. For those of you that don't know what Gusto is a payroll company, mostly for small business owners. We use it for our business. We use it for our clients. It's a really, really great system. Okay, they don't pay me to say it. Okay, but I love using Gusto. And Chris is actually using Gusto. So Chris is saying, Boris, I'm processing my payroll on Gusto, but I'm paying for my own health insurance through my personal credit card. So can I set up my health insurance reimbursements following your video, right? For those of you that haven't watched the video, go ahead and watch it. On Gusto, the answer is yes, Chris. Okay, so I personally pay for my health insurance through the business credit card, not through the personal, but you can still do it through personal, given the fact that your business will reimburse you for it, and you can definitely set it up in Gusto. Now, it does get a little bit tricky setting it up in Gusto on your own, especially if you're paying it from the personal account. Definitely, please make sure you do it with your tax advisor so that it's set up properly and the reimbursements are properly going out, okay, from the business to you personally, because you're already paying for health insurance. But what I would recommend, change that, Chris. Pay for health insurance from the business credit card. Include it as part of your salary in Gusto. Okay, then the Gusto will sync with your QuickBooks Online. It will offset that expense that's going out from your business credit card. That is how I personally have it set up for my own self in my S corporation. I paid with a credit card on the business credit card. I have it on Gusto, and then to kind of wash each other out when everything syncs into QuickBooks Online. I strongly recommend, again, do it with a tax advisor, okay? Perfect. Next question.
Question from Kit.
Kit, what's going on, Kit? Say hello in the chat before we read out your question. We're waiting for your hello. 3, 2, I'm kidding. All right, by the way, if you guys like this video, can I see some hearts in the video? Let's go, Mariana.
Okay, if an LLC that held real estate and has unused carry forward losses gets dissolved, what will happen to those losses? Can the owner take those losses as a personal deduction?
Okay, great question. This is Kit, right?
Mm-hmm.
Guys, pay attention to Kit's question, okay? There are business owners that could be in this situation. So you've got an LLC, right? You're an owner in it could be an LLC, a partnership, an S corporation. For whatever reason, there was a situation where you were not able to take those losses, whether you didn't have enough equity in the business and you had suspended losses, or it's a real estate and it's passive losses and they were just piling up, carrying forward in your business. Okay. So until when can those losses be carried forward? So Kit is asking, hey, Boris, I've got all these losses built up in my LLC. If I dissolve an LLC, let's say the business is closed, it's gone, it's done, nothing happening, and I file a final tax return with a final K1, can I then deduct these losses on my personal taxes? The answer is yes. So for those of you that have built up carryover losses, whether it's from a property on a personal return even, or on a K1 from an S corporation or partnership, when you file a final return and you get a final K1, all those losses now become deductible to you. Kit, say hello in the chat. Let's continue.
Question from 27 Sudar San. I recently sold a partnership property.
Is that who did you say it is?
Sudar San.
Sudar, say hello in the chat. Let's go. All right.
Recently sold a partnership property and got my third of the proceeds. Unable to do the 1031 exchange in my new personal property via a new firm using the proceeds, hoping I can write off the capital gains.
Yeah, let's go through the facts again. Let's go through it slowly.
I recently sold a partnership property.
So this is Sudar. So Sudar recently sold a property. Okay.
He got a third of the proceeds.
When you say you got third of the proceeds, what does that mean exactly? Okay.
Unable to do the 1031 exchange in my new personal property via a new firm using the proceeds.
Okay.
Hoping I can write off the capital gains. There were 3 partners.
So I'm not really sure how you can write off a capital gain. So what you mean by that? So if you sold a property, so I'm guessing you're a 1/3 partner, you were not able to do a 1031 exchange. For those of you that don't know what 1031 is, it's like kind exchange. If you sell a property and you buy the same one within a certain amount of time frame, and you put your proceeds, your gain into that new property, then the gain on the of your first property is not taxable. So Sudar said he wasn't able to do 1031. Can I still not pay capital gains taxes? I'm not really sure what your situation is like. In most cases, if you have a profitable sale, you would have to pay capital gains taxes unless you speak to your tax advisor and he can come up with some creative ideas and so forth. I'm not going to get into details about here, but there are ways that you can actually not pay tax on the capital gains. You can still do some of the opportunity fund zone, okay, even though that'll just be deferred up until 2026, and maybe some other items. Next question.
Question from Alex Vinoy. My LLC won't open for business until next year. Is there a way to deduct any of the expenses from this year toward the business planning and prepping?
So this is Alex. Alex, great question. So Alex says, Boris, I'm starting a new business, okay? And it's not going to be ready and start operating until next year. Now, I have expenses for this business. Are these expenses still deductible? So Alex, first of all, there is something that's called startup expenses, right? Startup expenditures when you start your business. Now, up to $5,000 of those startup expenses are deductible when the business is open, when you open the doors for business, so to speak. So if you're ready to start doing business January 1st, 2024, then the $5,000 will be deductible that year. Anything over the $5,000 up to $50,000, they start getting amortized, meaning so you can't get a 100% deduction, you have to amortize it, okay? Now, anything over $50,000 in startup expenses, they basically start getting phased out. Now you might say, Boris, this is very, very unreasonable. That is true. It is kind of unreasonable to do that. You're a new business, you've got all these expenses, but remember, what are those expenses? Because you can actually break down expenses into different categories, right? What if you're buying equipment? Equipment is not part of the startup cost. It actually falls into depreciation or Section 179. I've done a lot of planning for clients around that. So when you're starting a new business and you're going to have a lot of expenditures, it's super, super important to just speak to your tax advisor. Be like, hey, this is what my expenses are going to be. This is what I'm buying. And I want to make sure I want to plan around the fact of going around the startup expenses. A lot of people will be like, all right, great, yeah, it's my business, new business, startup expenses. I can take those startup expenses. There are limitations, but if you plan accordingly, you can break out those expenses. Maybe some are assets, right? They don't have to be in the startup expense phase. Next question.
It's not a question, it's a comment. Leela Smith, hello. I appreciate this information. Thank you.
You're welcome, Leela. All right, guys, let's do it.
Question.
So today we're gonna have an early stop, guys. We're gonna stop at 12:30, 12:40 today. So we got 14 minutes. We're gonna stop in 10 minutes, and then we're gonna announce winners. Let's go.
A question from Steven Anderson. I'm reluctant to purchase a home because of high interest rates, maybe $1,000 more a month. Am I basically getting that money back when written off at the end of the year? So higher payment, no big deal.
So who was that?
Steven Anderson.
Steven, I want you to give me a clarification. Are you buying a rental property, like an investment property, or a personal home? Next question.
Iron is asking, is Gusto better than Patriot payroll software?
I believe I've seen clients on Patriot. I love Gusto. Like, it's super, super cool. We can actually give you our affiliate link. You get $100 if you sign up, and we get $300. Okay, I think we get 300. Mariana, can you post affiliate link in the chat?
Yeah.
Do you ask Panchi about it? If you Slack her right now, she'll send you the link. You can post it here. We'll put it in the chat for you, for those of you that are interested. Next question.
Kit is asking, in depreciating a business vehicle, if you use the mileage standard method the first year, in future years, can I switch back and forth between actual and standard method as often as I want?
Okay, Kit, that is an excellent question. I am going to answer your question, but I also have a very, very detailed question about it on YouTube. I think the title of the video is how to write off your dream car. Definitely watch that video. Now, Kit is saying, Boris, if I start using standard mileage method, can I change to actual method and depreciate? For those of you that don't know what Kit is talking about, because he seems like he's a smart guy, right? Knows all this terminology. All right, let's kind of explain what he means. When you buy a vehicle for the business, there's two write-offs that you can take. Write-off number one is a standard mileage rate. Write-off number two is an actual method. The standard mileage rate, basically IRS says we're going to reimburse you. What's the standard mileage rate these days? I don't remember the last client with its standard mileage rate for. It's 65 cents, I think, right? Or whatever that is. Don't quote me on that. I could be totally wrong on that. The IRS reimburses you like 65 cents per mile, for example, and you have to keep track of your miles. That's it. That's all you're going to get as a reimbursement from the business to yourself. Now, I normally recommend going the standard mileage rate if your business is using less than 50% of your vehicle. The business is using, yes, less than 50% of the vehicle. Now, also depends on the cost of the vehicle and so forth, but generally speaking, in my firm, we kind of calculate it based if it's less than 50%. The actual method is when you reimburse yourself for the actual expenses of the vehicle, such as number one, depreciation, number two, gas, and repairs and maintenance, and insurance for the actual expenses. So Kit is asking, hey, Boris, if I'm using standard mileage rate right now, can I switch to actual next year and then go back to standard? Unfortunately not. Okay, you can switch from standard to actual, but you cannot go back from actual to standard. So once you switch from standard to actual, you're stuck. Or if you started using actual expenses, can go back to standard. Mariana, next question.
Okay, I'm just going to go back to Steven Anderson's question because he responded, it's a personal home.
Okay, Steven, let's talk about that, right? So Steven said, hey, Boris, I'm about to buy a home. Interest rates are through the roof. My monthly payment is going to be $1,000 more. Now, Boris, then I'm going to get a deduction for my interest payment. So should I still buy it? Will it make sense? There's two things to consider. Number one, if the mortgage on your home is more than $750,000, Steven, you're going to be limited on how much you can write off in interest. I'm not going to talk about those limitations. I'll be honest with you. My software does it for me. Okay. Now, I'm not some kind of a genius, guys. I know all of you think I'm a genius. Thank you. Thank you. Thank you. But no. So it's more than $750,000. You already get limited on that. The second thing is, remember, you're not writing off your tax liability dollar for dollar. You're writing it off your taxable income. So at $12,000 more interest expense, let's assume your home is less than $750,000. I'm sorry. Let's assume that mortgage on your home is less than $750,000, and you can write off the entire $12,000 of additional interest. Now, if you are in 30% bracket, that is $3,600 in savings, right? 30% times 12,000. Now, did you still pay more for interest than you saved on taxes? Yes, by about $9,000. Next question.
Isn't it a red flag to the IRS if your
Red flag to the IRS? Who said it?
Iron.
It's forbidden to say such words. I'm kidding. Let's go. Iron says, isn't it a red flag to the IRS that you're doing this video, Boris? Yes, IRS probably doesn't like it that I'm teaching you all these tax strategies that'll help you save money on taxes, okay? All right, Iron, let's go.
Isn't it a red flag to the IRS if your S corp is at a loss for 3.5 years in a row? I need to purchase equipment, but doing so will create a loss, and I'm scared IRS will audit me.
Now, here's the thing, right? There's certain things IRS does audit you for, and certain things we don't even know why IRS audits you, right? It could be a random audit, whatever that may be. So Iron is asking, Boris, I'm going to have a loss for 3.5 years. She's so exact. It's like she planned it out, okay? I'm going to have a loss for 3.5 years. Isn't it going to be a red flag to the IRS? Now, look, if you have losses for more than 2 years, IRS might consider this as a hobby loss, right? Like, hey, I think you're just in a business for hobby, and we won't let you deduct those expenses. Now, if you can come back and be like, no, this is not a hobby. My intention is to make profit. I just happen to be not profitable, and you show all the documentation and that your intent is to make profit, then IRS will be okay with it. Now, guys, Amazon had losses for like many years, right, before it became such a big company. So I'm not saying go ahead and use and abuse losses, but you would have to prove your case that this is not a hobby loss. But I would not be afraid of an IRS audit. If you need to buy equipment for your business, because that is an ordinary, necessary, and reasonable, right? You're not buying equipment just to save money on taxes. By the way, please, if you ever hear any advice online, buy equipment to save money on taxes. So what, you need to go broke? Like, you don't need to buy equipment just to save money on taxes. Remember, the money that you give out, it's still more than you save on taxes for the things that you don't need, right? Online, you see a lot of things. Hey, buy a car over 6,000 pounds, get a write-off. Buy equipment. By the end of the year, just keep buying. Spend money. Spend it. Please. Don't buy it unless you need it. Next question.
Jules,
we got 2 minutes left, guys. Let's go.
Last two questions.
Last two questions for the day. Jules, can I get a hello and a heart like over here? Let's go.
Can someone do depreciation of a property that is outside of the United States?
Can somebody do depreciation of the property that outside of the United States? I will generally answer this question because I'm not really an expert on anything foreign related. So I don't even touch anybody's taxes if they even own a property outside of the United States, okay? Just because it's a different animal, I don't really specialize in it. But generally speaking, yes. As far as I know, on a foreign property, hopefully I'm right. But definitely look that answer up or ask somebody who specializes working with individuals that have property outside of America. Yes.
Kit, she's saying, this is my fourth question. Can you use...
Kit, fourth question. Oh, by the way, guys, we're about to announce a winner. The first winner is going to get the S Corporation Tax Secrets book. The second winner is going to get Thinking Outside the Tax Box. The third winner is going to get a free 3-year look back, okay? But in order for you to get a 3-year look back, you have to have a business so I can actually review it, okay? If you have a personal taxes, no business, sorry, it's a no-no. You've got to stay till the end. We're going to be announcing the winner. Let's go. We've got a couple of minutes left. Fourth question, Kit, let's go.
Can you use a residential single-family rental property as an office for your business and deduct the rent, etc.?
Yes, you can. Next question.
Last question. If I'm trying to save up for a property, I shouldn't put money away into a retirement account because I will need the cash.
If I'm trying to, say it again, if I'm trying to save up money for
a property,
yes,
I shouldn't put money away into a retirement account because I will need the cash.
Are you making a statement or are you asking a question? But let's kind of elaborate on that. That was from Chris89, right? So Chris saying, hey, I'm not putting money into the retirement account, not getting a tax write-off because I'm saving money for a property. Now, you're right. You're not getting a tax write-off on a retirement account. If it makes you feel any better, you would still pay tax on it when you do retire. So the fact that you're saving it up for the home, temporarily. I think it's fine. Kins is asking, can you explain PTET for California? I would love to, but we are out of time. I would recommend that you please look at the PTET video that I have on YouTube. But for the PTET for California, I believe, if I'm not wrong, the election for PTET tax in the state of California is past due. I think it was due on June 15th. I could be wrong. I would have to confirm with my team. But PTET for California, if you live in California and you have a profitable business, ladies and gentlemen, PTET is a huge strategy for you. Please watch my video on that. Now let's announce the winners, Mariana.
Kins actually won the 3-year look back last.
Oh, Kin, you won 3-year look back last week. Our video cut short. Mariana brought it up. Thank you so much. You won a 3-year look back. Make sure you email us. First of all, did you get that Gusto link?
I did. I already shared it.
All right, guys. Let's put it again because there's no question, so everybody sees at the end. All right, guys. We have a Gusto affiliate link. If you want to sign up for payroll with Gusto, you'll get $100 if you use our link. So Mariana is going to put that in right now. Okay, Mariana did put it in. It'll appear in a minute. And we're also going to put in the email address where you can email, be like, hey, Boris, I want this thing from you, whatever that is. Can we get the names meanwhile?
Yes.
All right, cool. Let's do a drum roll, guys. Come on. Let me see some drum roll. Some drum roll emojis. Drum roll. Boom. All right. So, Kins, definitely reach out to that email address that we're about to put. You won last week. All right. So, I've got 3 names. Here, the paper is hidden. I don't even know what's going on here. All right. Put it behind my back. And then let's see. Thank you so much. You're amazing. Oh, yeah. Only my wife doesn't say I'm amazing. Thank you. Thank you, Jules. She was actually complaining today. I don't give her enough compliments. How many compliments does a woman need?
A lot.
Okay. Kins, no more Kins, no more question. A lot. You're spoiled. All right. What name is this? Kit. All right, Kit. You won we said the first prize is going to be S Corporation Tax Secrets book. Make sure you email. Mariana, I don't see your links that you're posting.
Really? I don't see them here too, but I see them here. I wonder if we're getting any other questions that are not popping up.
Yeah, I'm wondering. Guys, did we miss anyone's question besides Kin's, the one that we're not answering right now? So, Kit, you've got S Corporation Tax Secrets book. This is going to be mailed to you. I'm putting your name in this book. We're going to mail you exact same book with your name, with a piece of paper with your name. All right, next one, which is thinking outside the tax box. Let's go. Can I get some drum roll, guys? Can I get some drum roll? Let's go, let's go, let's go, let's go, let's go. First thing joining in the live, and I won. Definitely liking the subscribing. Wait, how many of you are actually not subscribers to my channel? Let me know. Say not a subscriber or new subscriber from this video. I would love to know that. All right, let's get the paper going. All right, cool. This one is Alex Vinoy. All right, Alex, we got this book. We're putting in our email address. Cool. Alex, this is new. Orland, make sure you subscribe. All right, cool. Alex, we're going to mail you the Thinking Outside the Tax Box. Now, the last one, the 3-year look back. All right, let's see. 1, 2, 3, and this is Steven Anderson. You got a 3-year look back. You just have to email that email address that Mariana just posted. So email that email address and we'll send you everything that you need. I will personally review 3 years worth of business and personal taxes. All right, Steven Anderson, are you here, by the way? Kins, well, you already got 3-year look back, so you'll be speaking with me and I'll help you with your 1099, I promise. Okay. All right, cool. Mariana is also putting in the Gusto affiliate link. Let's see if that's going to go through. Yes, that's Gusto, guys. That's the payroll that we use for us and for our companies. Great feedback. I personally like it. Go ahead and use it. How can I get a hold of you? Kins, we just posted the email address. Boris.Musheyev@BorisMTax. If you email there and say, hey, I want 3-year look back, we'll go ahead and tell you where to upload your returns. I'll personally review them and you and I will get on a call. All right, guys. For those of you that are interested for a tax advisory services to work with us, Mariana is putting in a link, www.taxplanningcall.com. That's www.taxplanningcall.com. Okay, www.taxplanningcall.com. Thank you, everyone. And until the next time, I'll wait until that link is posted, and that link is posted. All right, guys. You're welcome. All right, cool. I think we're good. Let's end the stream. Hey, guys, next week, till the next week, okay? Perfect. Every Thursday, it's 12 p.m. Eastern time.